Hello everyone, welcome to another video where today we're going to be discussing about accounting rules. Now, first of all, you have to understand that accounting is a principle-based subject. So what that means is we don't have fixed rules for everything, but rather we have principles that dictate the actions. Therefore, accounting principles are, flexible and they can be applied in any kind of business scenarios. So as long as they meet certain kind of characteristics or certain kind of criterias, then you would treat a transaction in a particular way. So that's why whether you are running a fast food business or you're running a clothing business, as long as the transaction meets certain kind of criterias, you treat them a certain way. Okay? So we're going to be covering the concept business entity, consistency, duality, going concern, historic cost, matching, materiality, money measurement, prudence, realization concept. And then we're going to go through different kinds of applications and different kinds of impact that they may have on the financial statements. So without further ado, let's go through the chapters. Now, first of all, let's go through the business entity concept. And business entity is defined as the business entity principle means that the business is treated as being completely separate from the owner of the business. So what that means is the owner and the business are considered as two separate entities or two separate, bodies or individuals or something like that. Okay. So the application of that is capital. So what does capital mean? Capital is when the owner puts resources into the business. This is the first transaction of any business because the owner always starts the business by putting his own money or assets into the business, right? So most of the time the transaction is debit, bank account. So you're putting money in the bank and you credit your capital account. So you're crediting your capital account because the owner has put money in the business. Now remember, in accounting, anytime you have credit, it usually means you have a liability, right? So credit capital because the business owes the owner back his initial investment, okay? So the business has a credit capital because he owes it back to the owner, all right? Another concept that you can say is the business entity is when you're paying for your personal expense. So when you're paying for your personal expenses, it is different than the business expenses, okay? So say, for example, the owner pays his personal rent. If he pays his personal rent, we call that as drawings because he has taken money out of the business to pay for his personal rent. Okay? So this is another application of the business entity concept. Right. Now, the second concept that we're going to be looking at is called consistency. So consistency means that whenever you're treating certain transaction in a first year, you got to treat it the same way in the second year, third year, fourth year, and so on and so forth, until or unless the change in method would provide a more accurate presentation of the business. So without further ado, let's look at what consistency is defined and what are the main applications, right? So consistency here is defined as the accounting method that must be used from one accounting period to the next. So most of the time, this is with regards to depreciation method or other kind of accounting like valuation method that you use, such as inventory valuation, right? So say, for example, when it comes to depreciation, you have, like approaches such as the straight line method, or you've got your reducing balance method. So whichever you apply, you have to use it every year, okay? Because they would give you very different value on a given year. If you remember, straight line method gives you same value every year for depreciation because you're charging it across the useful life. But if you use reducing balance method, the depreciation is higher at the earlier years, reducing for the latter end of the useful life. Now, straight line and reducing balance method, why they are applied in a way, it's because of the type of asset. Like say, for example, mobile phones, they have a rapid rate of decline at the early years. So that time it might be more appropriate to use reducing balance. And you've got straight line method for assets that are equivalently used for over their useful life, such as most of the time I would give an example like microwave, because I feel like my microwave works consistently over the years. Okay. And when we're looking at another concept called duality concept. So the duality concept means that every transaction has two aspects, a debit and a credit, right? So that's why whenever you're doing an accounting, like if you remember the accounting equation, assets equals to capital plus liabilities. Now, whether you're like with any transaction, there will be a debit and a credit. So either you're one, like say, for example, your customer pays you back, right? So if the customer pays me back, my money is increasing. So bank account debit, and my customer is credit because he no longer owes me. So can you see over here the fact that there is debit bank, one asset is going up, credit customer, another asset is going down because he no longer owes me. But regardless of what the movement is, there will always be a debit and a credit. Okay. And then we go on to going concern. So going concern is one of my favorite concepts because it's so realistic. Now, what I mean by that is that going concern basically means that the business will continue for the foreseeable future. And in this case, they've defined it as indefinite period of time, right? So there is no intention to close down. And foreseeable future is usually defined as the next 12 months, right? Because it's the financial year. So within that financial year, you have no intention of closing your business. So that's why you're using the going concern. So what that means is that when you look at a table, right? Or when you look at a car, there's a very different kind of valuation when you are thinking about using that car for the next 12 years. And when you're thinking about selling the car within the next 3 months. So when you are forced to sell an asset, right, then you would get a different kind of valuation compared to when you are going to use an asset over its useful life. So the alternative of a going concern basis is the breakup basis, right? So the breakup basis is when your business is not doing so well and it's expected to cease in the near future. Okay. Another concept that you can see over here is called the historic cost concept. So the historic cost concept says that all assets and expenses are initially recorded at their actual cost. So there is a difference between historic cost and fair value, right? Fair value is defined as an asset's price, like a price, not an asset's price that is determined by using the actual reported value through another transaction, right? So like the selling price that two different persons in a transaction would actually pay for. In accounting, we would call them as market participants, but we don't have to use that term here. So why do we talk about historic cost? Because it's very fair. Now, if I say that I bought my keyboard today and I purchased it for say 70 pounds, right? That's a fair, that's called historic cost because I actually paid for it and I paid 70 pounds for it. Now, what if someone walks in the door and they say that I've bought my keyboard, but I value it at around 150 pounds. Now, even if he bought it for 70 pounds, he's claiming that its value is 150. Do you understand what that is? So anyone can walk in and say that the value of their asset is like 100, 200, 300. So what historic cost does is it makes it very fair. It gives a reasonable benchmark for you to compare where the assets are deriving their value from. Okay, so we're moving on to the next concept, which is called the matching concept. So the matching concept says that the revenue of the accounting period is matched against the costs of the same period. Now, how I think of matching concept is that for every income, there is an associated expense. So that's how you match them, right? And another application of the matching concept is that you try to match the periods to which they relate to.